Welcome back to the deep dive. Today we are taking on a pretty massive mission. We're going to try and chart the entire economic landscape of the Walt Disney Company.
And we're going straight past the headlines. We've got their recent Form 10-K annual report for the fiscal year that just wrapped up on September 27, 2025. This is the engine room.
It really is. And this isn't just about, movies and theme parks. It's about a highly complex, interconnected, global corporate structure.
I mean, when you look at the top line number for fiscal 2025, it's hard to even comprehend. We're talking about a machine that generated an absolutely astonishing $94.4 billion.
$94.4 billion. To really get your head around that, you have to stop seeing it as just one company, Disney, and start seeing its structure. So let's unpack that. The report lays it out pretty clearly, right?
Yeah.
3 massive engines.
That's right. They've structured their entire operation into 3 main segments: entertainment, sports, and experiences. And each one tells a very different story about where the money's coming from, where the risks are, and where the big bets are going.
So let's put some numbers to that for FY 2025. Entertainment was the leader, pulling in $42.5 billion.
Right behind it, experiences. So that's all the physical stuff, parks, resorts, the cruise ships. That came in at $36.2 billion.
And then you've got the live-action engine of sports, which is, mostly ESPN, that brought in $17.7 billion.
And the movement within these 3 pillars, that's what really tells us where Disney is placing its most aggressive bets. Let's start with entertainment, that $42.5 billion content factory.
This is where you really see the tension, isn't it? The old legacy business versus the future streaming bets.
Exactly. The entertainment pillar itself is built on 3 different revenue streams. You have the old guard, the linear networks.
So that's your affiliate fees from cable companies, advertising, all that.
Yep. Then there's the future, the direct-to-consumer or DTC. So subscriptions, and of course more advertising. And then the third piece is content sales and licensing.
Theatrical releases, selling shows to other services, even stage plays.
Now what's fascinating here is the operating income. I mean, despite the content wars and all the industry headwinds, this segment saw a significant 19% increase in operating income in 2025.
Which sounds great on paper. You hear 19% and think, wow, they're running this thing really efficiently.
But, and this is a big but, that increase lives in the shadow of a truly staggering cost commitment. You could almost call it an operational treadmill.
Okay, so the report says that content production costs are capitalized. For anyone listening who might not be deep in accounting jargon, what does that actually mean in real terms?
It's a really important concept. It means Disney doesn't treat the cost of making, say, a new Marvel movie as an immediate expense that hits their books all at once. They capitalize it. They treat it like an asset. And then they allocate that cost across all the different ways they make money from it. The theatrical release, the broadcast on a linear network, and then eventually putting it on their DTC platforms.
So it spreads the financial hit out over years, which smooths out their earnings. But it means you need incredible amounts of cash up front.
Incredible is the right word. And the commitment to feeding that treadmill is massive. For fiscal 2026, the company expects to spend approximately $24 billion on produced and licensed content. And that includes sports rights.
$24 billion, that's nearly a quarter of their entire annual revenue, just on content. It's what you have to do for the DTC strategy to work, I suppose.
Absolutely. Now let's pivot to sports, the $17.7 billion segment. It's almost all driven by those affiliate and subscription fees from cable and streaming plus advertising.
And we also see their big partnerships here, like the 50% stake they have in A+E with Hearst.
Right. But if entertainment is all about aggressive investment, the sports segment actually showed a strategic retreat this year, specifically internationally.
You're talking about the Star India transaction.
Exactly. On November 14th, 2024, Disney did a major structural simplification. They finalized a joint venture with Reliance Industries and basically moved all of Star India's assets into this new venture.
So Disney's stake is now, 37%? And the key part is that its financials are now deconsolidated.
Precisely. That's the critical word. They no longer have to fully account for that massive operation and all its risks in their main financial reports, even though they still have a big interest in it. It's a de-risking move.
It lets them simplify and focus on their core markets, like the U.S.
Right. So if sports is about simplification, experiences, that's the aggressive forward bet. This is the third pillar at $36.2 billion. And this is, it's widely seen as the company's ultimate cash flow generator.
The dependable, high-margin engine.
Totally. The revenue just flows from every single guest interaction. Park admissions, food, merchandise, hotel stays, you name it.
And this is where the tension between the segments gets really clear. We just talked about a planned $24 billion for content next year.
Mm-hmm.
But the report stresses that the majority of the company's capital spending in recent years, the really big, expensive, long-term stuff, has gone to this segment,
But
experiences.
that's the critical trade-off,
Yeah.
They're using the consistent high-margin cash that the parks are generating now to fund the huge investments needed for the future of that business. New parks, new attractions, new cruise ships. It's a very different bet than a streaming series you have to renew every year.
Well, speaking of the future, let's decode that direct-to-consumer strategy,
Yeah.
because that's really the bleeding edge of the entertainment segment. The subscriber numbers from September 2025 show some interesting momentum.
For sure. Disney Plus hit 131.6 million subscribers, which is a solid 5% increase. But the real story, I think, was Hulu.
Right. Hulu jumped to 64.1 million total subscribers. That's a 23% jump.
An impressive jump. And most of that came from the Hulu SVOD only plan. And the bundle is clearly working as a retention tool. The report says 43.7 million subs have a bundle with both Disney Plus and Hulu.
Which locks you into the ecosystem.
Yeah.
But the ARPU, the average revenue per user, that's where the strategy really gets interesting.
It is. Domestic Disney Plus ARPU only went up a little, 2%, to $8.06. But look at international Disney Plus ARPU, a massive 19% increase, hitting $7.59.
So that 19% jump, that tells you they're done with the low introductory pricing in global markets. They're starting to flex their pricing power and really monetize that audience.
Yeah, and that might even be connected to that Star India deal we talked about. Prioritize monetization in the markets you fully control and streamline everywhere else.
But the king of the ecosystem, the highest value subscriber they have, is still the Hulu Live TV Plus SVOD user. They're bringing in a crazy $99.85 in ARPU.
Almost $100 a month. It's a phenomenal number, even if that specific subscriber group did shrink a little bit by about 4%.
And Disney clearly knows how valuable Hulu is. They moved to get total control in 2025, right?
They did. They finally completed the acquisition of NBCU's last 33%, paid another $400 million, and now they have 100% ownership.
And they immediately started reshaping it. They combined some of the Hulu Live TV assets with Fubo TV Inc., and now Disney owns 70% of that new combined entity. They call it NewCo.
It's just a constant restructuring to find the best way to deliver that live content and hold on to that near $100 subscriber.
Okay, so let's go back to the physical world, to experiences. That huge capital spending, you see it in the sheer scale of the operation.
Oh, absolutely. Walt Disney World alone is on, 25,000 acres in Florida? 4 theme parks, 18 hotels. It's basically a small city.
And the global footprint keeps getting bigger. We saw new details about Disneyland Paris getting a new Frozen-themed area in 2026, and they're renaming the whole park there to Disney Adventure World.
A major refresh. And then in their Asian parks, you see another layer of corporate structure. Shanghai Disney is 43% owned. Hong Kong is 48%. But they're both consolidated as VIEs, or variable interest entities.
We hear VIE a lot. Can you just quickly explain why they consolidate the financials when they don't even own a majority?
Sure. A VIE is basically a legal structure that lets Disney exert management control and pull out big fees for operations and IP, even if local rules say they can't own more than 50%. So because they run the show and get the profits, they can roll the results up into their main numbers.
Got it. And nothing says long-term capital commitment like their cruise line expansion. They already have 6 ships.
And the future pipeline is staggering.
Yeah.
It's a huge bet on global tourism. They have 2 new ships just in fiscal 2026, the Disney Destiny in North America and the Disney Adventure in Southeast Asia.
And that adventure ship is massive. 200,000 tons, 2,100 staterooms.
It's a floating city. And the source confirms they have 4 more ships planned between 2027 and 2031. This is a decades-long commitment to steel and infrastructure, a very different kind of risk than greenlighting a TV show.
And all of it, the parks, the streaming, the ships, it's all built on their intellectual property. The library is incredible, about 5,300 live-action films, 460 animated films.
And this is a major risk factor looming over that entire 100-year library. copyright expiration.
This is such a crucial detail, and I feel like it often gets missed.
The report explicitly calls it out. It says, and I'm paraphrasing, that the copyright for the 1928 short film Steamboat Willie and the early versions of the characters in it have now expired. This is them officially acknowledging that their oldest, most foundational IP is moving into the public domain.
Which directly impacts future revenue from those early characters.
Okay, let's pivot to the company's overall health and the big external pressures. On the financial side, things look strong. Cash flow from operations was up 30% to $18.1 billion.
That strong cash flow gives them a ton of flexibility, and they're prioritizing returning it to shareholders. They've declared a dividend of $1.50 per share for 2026, and they're targeting $7 billion in share repurchases.
$7 billion in buybacks is a massive number. Does that mean they're running out of big projects to invest in, or is this just keeping shareholders happy?
It's probably a mix of both, but it definitely signals confidence in their cash flow. They feel they can fund the parks, feed the content machine, and return capital. But the risk factor section, that's where you see the two big clouds on the horizon.
The first one is just economic reality. Yes, economic and inflationary pressures. They explicitly say that costs, especially for labor in the experiences segment, are going to stay elevated. So that hits them from all sides. Higher operating costs, maybe fewer people visiting the parks, and higher borrowing costs.
And the second threat, which might be the truly existential one for the $42 billion entertainment segment, is generative AI.
I think this is so important. The document calls out new technologies, specifically generative AI and large language models, as something that could fundamentally affect their business models, including how they make money from their IP.
And that connects right back to that 5,300 film library. I mean, generative AI can create low-cost custom content that could dramatically increase competition and threaten the whole model of paying a premium for their proprietary library.
Exactly. Why pay for a new Disney cartoon when an AI can generate something similar for you instantly? It completely changes the value of IP. And finally, on risk, we saw some detail on how they manage cybersecurity.
Right. The board's audit committee gets annual reports from the chief information security officer, who reports up to the CFO.
It's a very rigorous structure, which it has to be, given the stakes of managing this digital empire.
So we've seen a company pulling off a really complex strategy. They're committing huge long-term capital to experiences while restructuring media by consolidating Hulu and simplifying things with the Star India joint venture. And they're generating incredible cash flow while doing it.
It's a masterful balancing act, really. They're using the stable, reliable revenue from the past and present to fund the very uncertain, very expensive content arms race of the future.
But the long-term challenge is profound, and this is what we want to leave you with. You have a company built on 100 years of carefully guarded IP. Now, it faces a world where its oldest, most foundational characters are losing copyright protection. They are becoming public domain assets.
At the exact same moment that new technologies like generative AI threaten to just flood the market with cheap, competing content.
So the question is, what does protecting and monetizing a 5,300 film library even look like when your most famous character from 1928 is effectively public property and new content can be generated by a machine in seconds? That's the real challenge of balancing heritage with technological disruption.
It certainly gives us all plenty to think about as we watch where those billions of dollars flow next.
Absolutely. Thank you for joining us for this deep dive into the corporate mechanics of a global giant. We encourage you to keep exploring the implications of these massive corporate moves.